Advanced cost segregation, the 2026 tax strategy, killing it for short-term rental investors. The IRS literally has a legal loophole that lets real estate investors pay zero in taxes, and 95% of landlords have no idea it exists. In 2026, the rules are changing. The window is closing fast. If you own a short-term rental, an Airbnb, a VRBO, anything, and you are not doing this strategy right now, you are literally handing the government money that you are legally allowed to keep. I'm talking about wiping out $50K, $100K, even $200K in taxable income, legally, this year alone. Stay with me for the next 8 minutes because this one video could be worth more to you than anything you'll watch all year. Let's get into it. Why standard depreciation is robbing you. Here's what most real estate investors do. They buy a property. Their accountant says, great, we'll depreciate this over 39 years. Done. 39 years. Think about that. You bought a $500,000 short-term rental. Standard depreciation gives you roughly over $12,000 per year in deductions. $12,000. Meanwhile, you're pulling in $80,000 a year in rental income, and you're getting taxed on most of it. That is the old way. That is the slow way. And in 2026, that strategy becomes even more expensive if you wait. The smart investors, the ones building real wealth, they figured out something different. Something the IRS actually allows, but nobody talks about at your average tax appointment. It's called cost segregation, and when it's done right, aggressively, engineered properly, it's an absolute game changer. Break the building apart and win. Here's the simple version. When you buy real estate, the IRS sees one asset, a building, depreciating over 39 years. But a cost segregation study, done by an actual engineer, breaks that building into individual components. The flooring, 5-year property. The appliances, 5-year property. The landscaping, 15-year property. The cabinets, fixtures, specialty lighting, 5-year property. Instead of waiting 39 years to claim those deductions, you claim them now, front-loaded, year 1. On that same $500,000 short-term rental, an aggressive cost segregation study can reclassify 20% to 30% of the building's value. That's $100,000 to $150,000 into 5-year personal property. Combined with bonus depreciation, you could be looking at $80,000 to $120,000 in deductions in your first year of ownership. That's not a typo. That is real money. That is the difference between writing a check to the IRS and reinvesting that cash into your next deal. Are you starting to see why this matters? Good, because it gets better and more urgent. The clock is ticking. Here's why 2026 changes everything. Now here's where I need you to really pay attention. Pause if you have to. Write this down. Bonus depreciation, the accelerator that makes cost segregation explosive, has been phasing down. 2023 was 80%, 2024 was 60%, 2025 is 40%. Unless Congress acts, and right now the political landscape around the Tax Cuts and Jobs Act extension is moving, we could see a reset in 2026. Some proposals on the table could bring bonus depreciation back to 100%. If that happens, the investors who have already done their engineering studies and are ready to deploy, they win immediately. If it doesn't happen the way we hope, the investors who waited are stuck with smaller deductions for years. Either way, the time to act is now, not next year, not after tax season, now. The aggressive investors are already calling their engineers. They're already getting studies done on properties they bought 2, 3, even 4 years ago, because you can do a look-back study and claim missed deductions. That's right, you can go back in time on this strategy, but that window doesn't stay open forever. Why short-term rentals are the ultimate cost seg vehicle. Now here's why short-term rental owners specifically have an unfair advantage with this strategy. With a traditional long-term rental, cost segregation creates what's called passive losses, and passive losses can only offset passive income. But short-term rentals, Airbnbs, vacation rentals, if you materially participate in managing them, they are treated as non-passive income by the IRS. That means those accelerated depreciation deductions can offset your W-2 income, your business income, your capital gains. Let me give you a real example. You're a high earner, making $250,000 a year at your job. You buy a $600,000 short-term rental in Scottsdale, right here in the Phoenix market. You do a cost seg study. You reclassify $150,000 worth of assets. With bonus depreciation, you generate a $90,000 paper loss. That $90,000 comes off your $250,000 income. You are now taxed on $160,000 instead of $250,000. At a 35% tax bracket, that is $31,500 back in your pocket, not the government's pocket, yours. And that $31,500, that becomes the down payment on your next property. That is how the wealthy use real estate to fund more real estate. That is true ownership acceleration. The step-by-step play. So how do you actually do this? Here's the exact playbook. Step 1. Hire an engineering-based cost segregation firm, not just a CPA, an actual engineer who walks the property and produces a certified study. Costs between $5,000 and $15,000 depending on property size, but the ROI is almost always 5x to 10x minimum. Step 2. Make sure you qualify as a short-term rental under IRS rules, average guest stay of 7 days or less, and you materially participate. That means 100 hours of management per year and more hours than any other individual. Step 3. Work with a tax strategist who understands real estate, not a general accountant. This is specialized work. The difference in outcome can be 6 figures. Step 4. Do a look-back analysis on properties you already own. If you've owned a short-term rental for 1 to 4 years and never did a cost seg study, you can file a catch-up depreciation claim. That is found money sitting on the table right now. Step 5. Stack this with other strategies. Entity structure, 1031 exchanges, oil and gas deductions. This is how you build a tax-free wealth machine that compounds year after year. The investors building generational wealth aren't smarter than you. They just know the rules of the game. Listen, I built my portfolio in the Phoenix area using exactly these strategies. I've watched people overpay the IRS by 6 figures, year after year, simply because nobody told them this was possible. This video exists because I want that to stop. If this opened your eyes, and I believe it did, here's what I need you to do right now. Number 1, drop cost seg in the comments below. That tells me you're serious, and I'll make sure I go deeper on your specific questions in future videos. Number 2, smash that like button. I mean, really hit it. The YouTube algorithm needs to push this to every real estate investor who's leaving money on the table. Number 3, subscribe and hit the bell, because I'm dropping a follow-up video on how to combine cost segregation with 1031 exchanges to never pay capital gains. You do not want to miss that one. Number 4, share this with one investor friend. That one share could save them $30,000 this year. And if you want me to walk through your specific property and show you what's possible, the link is in the description. Let's build this together.